Hi guys, and welcome to our DeFi Live panel. We have a really interesting discussion today. My name is Layah Heilpern, and we're talking about CBDCs and we're talking about stablecoins. Very current, given governments and central banks all around the world are all talking about creating their own digital currency. So we have a really fantastic panel with us today. So I'm going to go around and ask everybody to introduce themselves. So first, Johny, let's come to you. Great to have you, Johny.
Hi, good afternoon. My name's Johny Fry. I'm CEO of a company called Team Blockchain, where we're working currently with a couple of banks on creating a stable coin. We actually write a weekly analysis looking at how, where, and why blockchain and digital assets are being used. Been doing that since March 2018, so coming up for 4 years, called Digital Bytes. So we're looking at these. This is, as you say, very, very topical and something whereby interesting, if you like, governments are being led by demand from retail and institutional investors. So happy to be here today. Thank you.
Thanks, Johny. Imran, let's come to you. Good to meet you.
Hello. Thank you. Pleasure being here with you today. So my name is Imran Khan. I'm EVP of Partnerships at Bitt. We digitize national currencies around the world, and we're best known for digitizing the currency in the Eastern Caribbean Central Bank, as well as the Central Bank of Nigeria. I was the project executive on that, so I'm sure that topic will come up. Looking forward to the discussion.
Absolutely. Yeah, absolutely. Nigeria pushing ahead with their e-naira, so we'll definitely have to talk about that. James, great to meet you. Can you introduce yourself for us?
Yes. Hi, everyone. I'm James Bennett. I'm the CEO of Gold Token SA. We were the first gold-backed stablecoin to launch with FINMA approval in Switzerland. We're a joint venture between CoinShares, Europe's largest asset manager, and MKS PAM Group here in Switzerland.
All right, so clearly a very exciting panel today. So I do want to just start with the basics because a lot of people might find understanding the difference between CBDCs and stablecoins a little confusing. So Johny, let's start with you. Can you just explain for us the difference between stablecoins and CBDCs?
Well, stablecoins, bizarrely, are probably completely misnamed because stable is a relative term to where you're spending and where you're earning your money. So, for example, if you're earning money and you're based here in the UK, then something based in sterling is classed to you as stable. But if you're like James over there in Switzerland, then the last thing he probably wants to do is earn any pound sterling because the pound goes up and down against a currency. So I think perhaps what they ought to be called, bizarrely, is pegged coins. They're pegged, linked to a currency, typically. But it doesn't have to be a currency. And I'm sure James will talk a little more about pegging it to a commodity like gold. So stable coins, peg coins are typically linked to something which we would think of as a fiat currency. Central bank digital currencies, they typically would be linked to the assets of that country. And they would typically, therefore, be linked to the way that country values its currency. So it might be the Nigerian lira, for example, or we've got the Chinese yuan as another potential example, although that isn't run on a blockchain and arguably shouldn't be classed as in the same sort of context as sort of things that most other countries are looking at. So one was typically issued by government, I suppose, and the other one would be issued by a public company or an organization.
And the use cases are very different. So James, can you talk to me about the use cases and how they differ?
Yes, that's a great question. I mean, I just wanted to pick up on what Johny was saying just quickly, which is, the idea that if you held a dollar for the last 100 years, you would have about 95% of your purchasing power. So, if you call that stable, then it's clearly not in terms of purchasing power what people really care about. We've probably all heard our parents tell us how much they bought their houses for, their first house for, 40, 50 years ago. And it's kind of like a couple of months' salary. Or our grandparents, it's a month's salary. So it's changed a lot. In terms of CBDCs and stable coins, I would say within the space, stable coins is very much the term that we use for those that interact directly with crypto. At the moment, CBDCs, because they are centrally bank issued, are going through a much more regulatory sort of process and aren't yet interfacing, with the cryptos that we see today.
So can you just delve a little bit deeper onto that regulatory process, because things are heating up globally at the moment?
Yes, absolutely. Well, for CBDCs, that's not really my area, so I might divert that over to Johnny or Imran. But in terms of stable coins, yeah, it's becoming really interesting because the stable coins that we've become so familiar with, Tether, Circle, and Paxos, just to name a few of the big hitters in the space, make up about $140 billion. And the way that they are kind of maintaining their peg against the dollar is through a combination of cash and commercial paper and other assets. In Tether's case, lots of fruity things in there, including crypto, which is great if you had exposure to the crypto. But ultimately, what you want when you're buying that stablecoin is to know, or the pegged coin, as Johnny so rightly put it, that it's going to keep its value to that dollar. And so the kind of regulatory discussion around that at the moment is that if the consumer, the end retail holder or even institution is holding this coin, then they need to know that the reserves are actually tangible, that they are there, and two, that they are going to be sufficient to back the value of that dollar. So again, in Tether's case, I think around 50% of the backing is in commercial paper, and that might be high risk bonds, commercial bonds. And so if you imagine that those bonds are defaulted on, then actually you don't any longer have the sort of dollar value against that tether that you're holding in your balance. So yeah, the regulators that be in the US, I think between the SEC and the Office of Controller of Currencies and a few others in there as well, are starting to say, look, maybe we need to regulate these like banks. These are depository institutes, and so these deposits that are backing the actual value of that dollar need to be more transparent and regulated and of a certain quality. Because they are becoming sort of systemic when we get to a couple of $100 billion there.
But what does that regulation look like? Because a lot of people use stable coins in the cryptocurrency space so that they don't necessarily have to cash out into fiat currencies. It's much easier. Sometimes it could be more tax efficient. So should people be concerned? What type of regulation could we expect?
Yeah, I'm happy to take that. I mean, I think for the end users, regulation's good in what I've just described, because you want to know that dollar is going to actually be backed by something.
Yeah.
So that's good. What we might find is that there's from the actual use case, the user point of view is that you have more KYC restrictions. So your balances might need to be reported if they're over a certain amount, so that when you're moving around, so let's say $10,000, then you might need to declare why you're moving it around, and we end up back in the sort of same banking structure that us in crypto in the DeFi conference are all trying to sort of evolve from, if you like.
Yeah, thanks, James. Imran, we'll come to you. You were talking about earlier. You were part of working on the e-Naira. So I'd love to hear more about that. Why Nigeria actually felt the need to do that, and whether that would actually solve the astronomical inflations that you actually see in Nigeria.
Perfect. Well, it's a great question. I'd like to start with the tagline, and it relates a bit with what Johnny was saying. What is the difference between a CBDC and a stablecoin? So in Nigeria, their tagline, if you go to eNaira.com, you'll see it's the eNaira, same Naira, more possibilities. So they really want to stress, and I'd like to really stress that a CBDC is not pegged to the currency of a country. It actually is the currency. It's just a new form of that currency. And physical money as well as a CBDC can coexist at the same time for different use cases and for different demographics. Now, why did they go into this? They've mentioned one key reason as the main driving reason, and there's so much more to come right after that. And they have a full list on their design paper, so I invite you to read that if you're interested. And the primary reason is really financial inclusion. Today, we're really dependent on the private sector to provide electronic money. So whether that's through telcos or financial institutions. Now, those are profit-driven organizations. And people believe that money should be a public good, should be accessible by all, just the same way as paper money is accessible to all. So all the different regions and different parts of Nigeria, whether it's a profitable area or not, the Nigerian government want to ensure that they are included in the future of commerce, and they are also onboarded into the whole world of the financial ecosystem, plugged into the traditional financial ecosystem too, so that they can get more efficient remittances coming into the country. But other reasons that they've stated is increasing collaboration with neighboring countries and boosting trade. Remittance was a big one, of course, and just promote innovation in the fintech space in Nigeria. We're just starting with simple infrastructure that I think a whole bunch of local fintechs and banks will really seize and innovate upon that.
Yeah, thank you
Laylah,
for.
can I just come
Yeah,
in
I
on
was
that,
just.
Laylah?
Yeah, I was just
Because
about to say,
I think,
I just want to make sure everyone knows that everyone just feel free to jump in. Just want to make that clear. And also the audience are welcome to ask questions.
okay, yeah. What I just wanted to add there too, Imran, I think one of the things, and if there's one message that I would like the people listening to this afternoon get, is that digital currencies are not just about making payments faster and cheaper. It's very much about what Imran's talking about in terms of making it much more inclusive. So if you look at the World Bank statistics, they claim there's 1.7 billion people in the world that are unbanked, that are financially excluded. Yet 66% of those people have access to some sort of mobile device. So, which means that if they can actually have a digital currency, they can then start interacting and maybe get small loans or make small investments. They can start becoming part of the financial community. And that's good and bad, to be fair. But it does mean that they have a choice, where at the moment it's very, very difficult. And one of the things that we need to bear in mind, and this might be rather perverse, what we don't really want to see is just central bank digital currencies at the exclusion of pegged stable coins, if you like. And the reason for that is that just come back to the UK, and if you had, say, £10,000 in NatWest Bank, and the Bank of England suddenly come and say, well, we're going to give you a pound stable coin, and you'd be mad to leave your money in the clearing banks. You'd take all your money out and you'd put it with the Bank of England, because there is a chance still that the banks could go bust. Look at Shearson Lehman, for example. So already the French have said you'll only be able to put €2,000 into a central bank digital currency, because they realize that the crazy fractional banking that we've had only for 50 years, but that fractional banking has created massive bouts of inflation and uncertainty. Whereas perversely with a stable coin, what you've actually got is that if it's done correctly, for every dollar, for every yen, for every Swiss franc, for every pound, is backed by the equivalent. Unlike if you go into your high street banks in many of the Western countries, say, I would like $5,000 or $10,000 yen, Swiss franc back now, they'll probably tell you to come back tomorrow or the next day. They physically don't have your money. And this is a huge concern, and people are beginning to wake up to the fact that it is a very fragile system that we're actually currently operating on, and it's not sustainable, quite frankly.
And so are you sort of saying that although governments and central banks are pushing for CBDCs right now, they will also eventually start pushing for stablecoins?
No, I believe what they need to have stable coins because, or certainly central bank digital currencies, because it'll enable them to maintain their position relative to where they are in terms of, if they don't have a stable coin, then they're going to find, or central bank digital currency, I should say, they're going to find other countries will start using as a proxy. And look, the elephant in the room is Facebook. They kicked a lot of this off back in 2018 by saying we're coming out with the Libra coin. Well, it wasn't Facebook; it was their association. And if you look at the people like PayPal, Mastercard, Visa, all of them were members of that association, and they've all left. And guess what they've done? They're all now accepting digital currencies, because they're actually today Mastercard have said they're coming out with their own Mastercard debit card, which will accept digital currency. So they're all putting down the infrastructure, the payment rails to be able to accept it. Because as Imran touched on with remittances, the remittance market is something in the order of about 600 billion a year. Now the remittance market is typically security guards, cleaners, nannies, nurses, people that are paid very, very poorly, and when they send their money back to their loved ones in the Philippines, in India, in Pakistan, and in China, they're being charged somewhere between 10 and 15% for the pleasure. So the very poorest in our society, we're scalping them, we're ripping them off. Whereas if they used a digital currency, they could move that money at a fraction of a percent, so be faster and cheaper. But more importantly, it's backed then by a pound. It's not reliant on, does Lloyd's Bank actually have any money in the bank today? Or does BNP, is it reliant on being bailed out by the French government, which may or may not happen? Now, I'm not casting aspersions on any of these names, but I'm just I just want people to realize that the money where their banks are actually not as safe as we'd like to think they are. And Shears and Lehman, you mustn't forget that 2008, people lost not only their jobs but a lot of money because the bank was too over leveraged. And UK banks are some of the most leveraged banks in the world.
Yeah, it's
I
truly concerning. No, go
No,
on,
I just
James.
wanted to pick up on that and say that I think that CBDCs don't necessarily solve the fractional reserves sort of problem. I think the bankers will continue to treat money in the same way as they always have. And it actually gives them more flexibility to be able to create money quicker and to move money quicker than ever before. But also, even in a more terrifying way, is that if for some reason your political view is not aligned with the current party, let's say we're in China right now, then having a CBDC means that someone can literally go to a central ledger and delete your money or restrict the movement of your money. You lose that agency, that sovereignty over the finances that you've built up over time, and that's a really sort of scary scene. And then on the other hand, you've got the fact that if you're pegging to a local currency, then you still are subject to inflation. I could create a digital bolivar, and it's going to have the same problems as the physical bolivar because it's tracking the price. So that's to say that although these things are very exciting, I don't think that they are necessarily solving any problems, bringing us to a new stage of money within societies. And in fact, there are some really exciting projects that are trying to tackle that head on.
Yeah, you're absolutely right, James. I was going to bring that up, and I wanted to direct that to Imran, given everything that's going on with the e-naira, obviously because you have first-hand experience. Inflation is astronomical. They already have incredible capital controls in the country. I think it's around $100 a month. You're not allowed to. That's the limit for international spending, I believe. So how would a CBDC solve this? Because you said it's the same money, but more possibilities. But that's not good that it's the same money because we don't like the naira.
Well, let me add to that. So it's a new form of money. So it is not, the objective is not to address Forex or the value of the naira versus other currencies. So that's not what we're trying to attempt with the e-naira. The possibilities that we're talking about is promoting financial inclusion, financial innovation, and then reducing the cost of financial services. Eventually, there's going to be programmable money and programmable applications. Monetary policy and fiscal policy that's going to be driven by more facts and more insights that digital money can provide. So the objective is not to work on the value of the naira. However, Forex markets could be improved through the digitization of the naira. So that is a possibility. But what actually will move the needle around that is much more policy decisions, not the technology. And to add to the point of Johny and James, the CBDC does not try to solve problems around the safety of the fractional banking situation we have. It's really a new form of cash. So it's really not replacing deposits at banks and saying we're going to do things differently from now on. No, banks will continue operating the way they do. We're really shifting money from the back pocket or from a purse to a digital form. So those are non-interest bearing forms of money today.
But Laylah, where it may actually help a currency is that it gives them a new tool to control their economy. And at one end of the extreme, as James touched on, you have the Chinese digital currency, whereby they literally can. They've been giving $30 equivalent in terms of like a red ticket, a bonus to people, 50,000 people at a time, and they say, well, you basically have 5 days to use the money, use it or lose it, and you can only spend it in these 3 or 4 outlets. And if you don't want anything from those outlets, then you've lost the money. So it is complete control over your finances, which some people may not agree with, may not like, but that's the way they've decided they want to go about it. But on another example, what it does, it gives governments like Nigeria the ability to really tackle their shadow economy. And the shadow economy, is a massive part. And I can guarantee every single one of you listening to me now are part of that shadow economy. You've all given a tip to someone to cut your grass, wash your car, clean your clothes, or buy you a drink or a meal in a restaurant. And the trouble is, the size of that shadow economy ranges anywhere in some African countries to as much as 70%, to places in the US and Europe where it's around about 15%. And governments are losing out billions and billions. And if they can digitize their currency, it makes it very, very difficult. So it's rather ironic that a currency that has come out of the crypto nonsense, because most of them are just nonsense, we have to be honest about that, but the technology behind them is now giving, if like, the compliance officers and the regulators and the governments, is giving them a tool to help them control, the economies in a much wider sense, which makes it really exciting. And I think what Inram's saying, okay, they may have only come out with one step of what they're trying to do, but as we often say, we don't know the questions, let alone the answers to what's going on the crypto world in its broadest sense, and the opportunity that it'll bring to make it much, much more efficient, much, much more transparent. And it's not just about financial services. This is right across the societies that we live in, whether you're a so-called developed country like the UK or a so-called developing country, in parts of Asia and Africa.
Johny, I'd like to add on that. So the sector-specific token has been publicly mentioned, and I've had conversations with the Central Bank of Nigeria. It's on the roadmap. It's in the design paper. You take a look at all the ideas, and the sector-specific tokens are really interesting. It's more in fiscal policy and trying to boost certain local economies in particular regions of a country. So you can have tokens that are only usable for tourism-like services. So merchants that deal in tourism industry in a particular region of the country. So when you're in a pandemic and you don't have the inflow of people into a country to promote tourism and to really help out that industry, you can issue those sector specific tokens. And I see a lot of good in that kind of economic stimulus, because you could put restrictions so that it just doesn't go and sit in a bank account and get saved somewhere, which wasn't the intent of that money. It's not to make the people who want to hoard cash, right? You could also get more insights on whether cash is being held in private wallets as opposed to being spent and moved around in the economy. And based on that, they can move levers to accelerate the velocity of money in the country. There's so many different possibilities.
Well, and I know there's a gentleman called Professor Stephen Castell who's he's promised he's watching this, so I said I'd give him a plug. He's actually been talking to the government about creating a sterling-backed coin, which is just for the residential property market, but not for sort of Mayfair penthouse apartments, but for sort of real affordable property, to be able to help people to be able to get, if you like, on the property ladder, and people could actually buy that coin and use that coin, but it's essentially going to be used to help build property. But just looking at a wider context, and the reason why digital currency stablecoins are going to become so much bigger, and we may go back to a situation whereby majority of global corporations end up with their own stablecoin, is because if you look at the situation with equities, and I'm going to pick on BP because it's a reasonably well-known oil company, or they're now called Beyond Petroleum, so maybe it's not oil, but there you go. I think we know who we're talking about, and they pay their dividends every 6 months. So if Imran, if you've held BP shares for 5 months and 30 days, and I come along and buy the share on the last day before it goes ex-div, I get all the income. You actually just see your shares, you don't get any income. So you've actually had all the risk of BP for nearly 6 months, and I've had all the income. Now, in the FCA and many of the other regulators, one of the preeminent things they're doing is they're trying to actually treat customers fairly. So you as the investor, how is that treating you fairly if you've actually not had any of the income, and I've actually come in as a pension investor, I'm desperate for my clients to earn income, and it's called dividend stripping. Well, you cannot allocate income based on the number of days or weeks held in our current paper-based analog system of equities. But as we start seeing companies like BP having digital equities that can be traded 24 hours a day, 7 days a week, they won't want to use the banking system. They'll want a digital currency to pay their dividend accordingly. And the same way with coupons on bonds, the same way with income on rental properties. So we're going to see companies using it very much as a mechanism, as part of their infrastructure. There's no speculation involved. There's no one trying to get around the rules and regulations. If anything, the regulators are potentially going to say, you have to pay it digitally because it's cheaper, faster, and you can actually work out what people are entitled to actually receive. And that's a very different stance to the current people saying, oh, it's going to save me a bit of money.
We have some questions coming through. I'm going to look at the CBDC related one since we're on the topic. So here's a very interesting one. So how is a CBDC going to promote financial inclusion if, as you say, money can be programmable, therefore being potentially exclusionary by design? I think that's a fantastic question.
Well, yes, but it can also be inclusionary by design. We have a crazy situation at the moment where I've got friends who live in America and they were given $1,200 each. These guys own 2 or 3 properties each. They have 4 or 5 holders a year. They don't need the money. And you've got the situation now in America. They're sitting on something like $1.2 trillion worth of cash because they didn't need that money. But there are millions of Americans who are desperate, living hand to mouth. And actually, if the money was automatically programmed to reach those people who had earned a certain level of income per annum on average for the last 5 years, or had a certain amount of capital in the bank, and they got the money, and it went to the people that really needed it, as opposed to the people that are going to save it. And that's a positive for the economy, because when a government gives money to society, you have something called basically an inflator and a multiplier. And for those that don't need money, they do exactly what Imran's talking about. They sit and hold it and put it in the bank, and that's not really what it was meant there for. But for people that don't have money, they actually go and spend it on some clothes and some food, and maybe I don't know, buy some other goods. But that money gets spent and it's multiplied, so its impact is actually much, much greater.
When we
okay,
look
so
at,
here's.
Sorry, can I take a slide down?
James.
Because I think the point of I think what the person is asking in the question is, do we trust our local governments to be creating the right policies that they're inclusionary or exclusionary? Do we feel like we have enough trust in the government and central banks that they have our own interests, at heart when they're designing their policies? And I think a lot of people in this space, in this industry, the reason we're here is because we don't particularly feel that amount of trust, and we want to take the power of our finances back into our own hands. And so, it's that simple. That's why you have a lot of these crypto collateralized stablecoins that are coming out, that now makes up about 20 billion, which is about 15% of the total market. And the velocity is much higher than what we see with the other sort of stablecoins. So they're actively being used. And with these crypto-backed stablecoins, you don't have to answer to anybody. In fact, you can still be long your favorite asset with a very sensible sort of over-collateralization ratio. And then you can take stablecoin out of that. Or you can just buy that stablecoin, off of the market directly and use that to interact with the different tools that you want to interact with. Like, let's not forget that the whole sort of DeFi movement is basically becoming your own bank, right? Or having access to these driverless banks, or where not driverless, governed by decentralized autonomous organizations, where the people that are participating, that are part of that banking system, have a say, have a sort of voting share. You can't call up your NatWest or Santander bank and, say, actually, I'd like you to start taking deposits in, this new currency, because they're not going to listen. You don't have a vote, despite being a customer. Unless you're a sort of majority shareholder or sitting on a board seat, they really won't be listening to you. But here, in these protocols that are being built out and rapidly expanding, people have a voice and they have a choice. And that's what I call inclusion, right? As opposed to putting your fate into the hands of an entity that maybe has let people down in the past.
But James, it's interesting to actually see what's happening in the DeFi space in relation to what you're talking about there with DAOs and the like. And being a bit of an old fart and north of 50, I can remember things called with profits funds with insurance companies. And these were mutual funds where the profits were all contained. And then at the end of the year, they would then get distributed to the unit holders, not the shareholders. And unlike the unit linked performance where it goes up and down every day, the cooperatives, the mutual fund companies were very much built on a community. And what DeFi, some elements of it, what they're doing is very much going back to a situation
Absolutely.
which had been extraordinarily successful for years and years and years, and having these mutual cooperatives. And actually, why do we need to then pay to these third parties, i.e. shareholders, which are typically large institutions or very, very wealthy people, and it's stripping out that layer of profits. But
yeah, and I think technology ultimately let down the growth of the cooperative. As they tried to grow and be borderless, and there were lots of, and also the huge financialization of those sectors, with the increase of activity on stock markets and everything else. Whereas now, technology actually enables those cooperatives to be more fractional and to serve people in specific, more contained areas, because lots of people have different circumstances, and there's not a one size fits all policy. I would say on that piece. I mean, Johny, what's your view on why the cooperatives sort of failed or went away?
Money. In the very short term, if you look at the building societies in the UK, they basically, you were a depositor in a building society, you owned your building society, and then someone came along and offered you, well, you've got £1,000 in the building society, we'll give you £200, a little bonus, if we can take control and take your vote. So we only have ourselves to blame. In the same way at the moment, we've got fear and greed running through the blood of the whole crypto market, because you got things like Shibu, or whatever it's darn well called, went up 84 million%. Yeah. 84 million in the last year. So £3,500 is now worth 1.5 billion.
Yeah, and even to your point of, like, even people that are owning position in DAOs, it's tradable on the market, and as the price goes up and up, then they'll sell at some price, and then you end up have a small group of venture capitalists that end up taking the sort of protocols governance in the long term. And so, the way that those rights are redistributed back to the people that are active in the protocol is really important as well. So we don't keep.
But James, the key thing that we're running across most of what we're talking about is the use of blockchain technology, and the key attribute of that technology is transparency. And so, therefore, to go back to the original question in terms of potentially exclusionary, well, yes, but it potentially could be inclusionary, and we could actually look and see, and therefore people will have that ability. At the moment, it's very, very opaque, and we really don't know what's going on. We really don't know the leverage on our various different international banks, and that can't be right. Whereas hopefully, if we've got some more information, we can start trusting what we're actually going into with more conviction. Well, that has to be a good thing. And then you make your choice. And if you're happy to go into a basket of sort of currencies run through a DAO because that's what you think is the appropriate thing to do, well, you've got that choice. But at the moment, we're being told by people in a nanny state way, no, you can't do this, it's not good for you. So people are finding ways to get around it, and this is why we've got the confusion in the marketplace.
And Johny, that's an excellent point. I don't think that every CBDC initiative will succeed. No. It really depends on whether they've designed it for the market that they're in, considering cultural norms, considering technological advancement, the will of the people, because there will always be other options on the side. And if it's not inclusive enough, well, there will be the other options that will prevail. And I think that's what's great about competition. It aligns incentives towards succeeding in each of the different avenues that we each take, whether it's private sector or public sector.
Yeah, very interesting. Johny, James, Imran, I want to thank you so much. It's been such a pleasure learning and hearing from you today. Thank you so much.
Yeah, likewise. Thank you, guys.